There are three assets that have built more wealth than anything else. That's starting a business, investing in real estate, investing in stocks. Now, investing in business can give you some of the best returns, but it takes the most time. It's not just an investment of your money. You have to actually create something, so it's the highest risk, highest potential return, most work, so I'm not going to talk about that. Let's talk about real estate and stocks. Real estate and stocks are two asset classes that are an investment of your money. You take your extra money, remember this money right here, and you're going to put it into that asset that's going to work to either grow or produce you cash flow. And even if you don't have a ton of money, yes, there are ways for you to get exposure to real estate. I'm going to talk about that in just a second, but you have to figure out where you want to start first. You don't want to do everything first. Start with one, get good at that, and then you can move on to the second investment, third investment, fourth, whatever it might be. But start with one, get good at that, learn it, and then work to expand from there. Once you understand which asset that you want to invest in, this brings us to step number 2 to investing your money, which is understanding how aggressive you want to be with your investment portfolio. There are two general frameworks that you have when it comes to investing in money. You could be a passive investor or you could be an active investor. A passive investor is something that's a little bit more hands-off. It's a set it and forget it strategy. So in the stock market, there are funds out there. These are called index funds or ETFs or mutual funds. It's just a basket of stocks. But the whole idea here is the way that you win as a passive investor is you're going to set it and forget it. You're just going to keep investing your money every week, every 2 weeks, or every month into these funds. With real estate, you can also invest passively because now you're going to invest into a real estate fund. And you can find these on the internet. Now, instead of going out and buying a rental property for yourself, you're going to find a portfolio of properties that you can get exposure to by investing in that fund. And now sometimes you can invest with as little as $100, sometimes even $10, and you're going to create a set it and forget it strategy where you just keep automatically investing this investment money into that passive fund. Active investing is a little bit more different. This is where it's going to be more risk for more potential return. And with active investing as a stock market investor, now you're going to be investing into individual companies. Now maybe you're going to invest in Tesla or Amazon or Apple. And it's going to take more work, more time, but more also potential return. It comes with more risk, but the whole idea here is if you're willing to put in the work and time, you can see better returns because, well, you're investing in the better companies. But if you're wrong, the company could go bankrupt and you lose everything. So you have to understand which side of the game you want to be on. In real estate as an active investor, again, I'm not talking about trading or flipping. With the real estate as an active investor, you're going to go out and buy a property yourself, and then you're going to rent it out for rental income. So you're going to manage the investment, but you don't want to actually manage the property. You want to have a team. You want to have a property manager who's going to have contractors and other people in their office that are going to do the day-to-day work, but it's your job to make sure that this property is actually generating cash flow. So as an active investor, you're not actually trading or flipping, it's you're doing the work to manage and operate your portfolio. As a passive investor, it's more hands-off. And there are three types of portfolios that I talk about, being 80-20, 50-50, or 20-80. The first number is active, second number is passive. So 80-20 means you're 80% an active investor, 20% a passive investor. Again, the passive investing is what gives you the protection. The active investing is more risk for more potential return. 50-50 is 50% active, 50% passive. 20-80 is 20% active, 80% passive. This is where the people that don't like too much risk, but you still want to be able to get some of the upside by trying to find some of those companies with a little bit of that extra money that could see those big gains. So now you got to decide how much risk tolerance that you have. If you don't have a high risk tolerance, then maybe you do 20-80. If you're kind of in the middle, maybe you do 50-50. If you're okay taking on more risk, which especially if you're younger, like if you're in your 20s, you don't have a lot of financial responsibilities and you want to take on more risk, well then maybe 80-20 is better for you, but it just depends. Personal finance is personal. I'm not a financial advisor. I cannot tell you what to do. I'm just a random guy on YouTube. I'm just trying to get you to think like an investor. And then you figure out how you're going to actually put it into action. Because step number 3 is execute. So step number 1 as an investor is you got to figure out where do you want to invest, stocks or real estate. Step number 2 is you pick how aggressive you want to be, 80-20, 50-50, 20-80. Step number 3 is executing. So when you are a passive investor, the way that you win is by following a strategy I call ABB. Always be buying. Now remember, as a passive investor, you're investing into a fund. And now you want to find a fund that is a strong fund. So I'll give you a couple examples. Again, I can't tell you what to invest in, but if you wanted to invest in the total stock market, the United States stock market, there's a fund out there called VTI. If you buy one share of VTI, you're getting exposure to the United States stock market, the 2,000 some stocks that are in the United States stock market. And so if the stock market's going up, VTI will go up. The stock market's going down, VTI will go down. you want to get a little bit more niche, you can invest in the S&P 500, which is a group of the 500 largest companies in the stock market. So one example of a fund that gives you exposure to the S&P 500 is SPY. Again, now you don't have to invest in all 500 of those companies. With SPY, you're getting exposure to the 500 largest companies in the stock market. And now the way that you win as a passive investor is ABB. Always be buying. Every week, every 2 weeks, or every month, money is going to leave your bank account from here and automatically be invested into your portfolio of funds, and you set it and forget it. The key here, the way that you win, is you got to always be buying. That means next time we see a recession, because we're going to see a recession, you keep buying. Next time we see a market crash, because we're going to see a market crash, you keep buying. The mistake that so many people make is when things go down, people panic. Then they freak out and they sell. That's not the way that you win. You need to hold your composure, and the only change you might make is during those downturns, you invest even more aggressively. So as a passive investor, the way that you execute is by ABB, always be buying. As an active investor, the way that you execute is by looking at what I call a market shift. This is what my firm specializes in. We study these market shifts. We have analysts that do this full time that are studying where the money is moving, because if you can understand where the money is moving through your data, through your research, well then that can create an investment opportunity, especially if you can find this research before it hits the headlines. For example, during the pandemic, everybody was buying a cat and dog, right? We've all seen this. Well, if more people are getting cats and dogs, that means more people are going to need veterinary services. More people need cat food and dog toys and all that stuff. Well, that creates an investment opportunity, because those companies that are selling those services are going to make more money. That can create an investment opportunity. That's what a market shift is. And when you can start to find and research those market shifts, now you're not trading or investing based off of what you see on CNBC and Reddit. You're investing based off of research and data, and you have some actual reasoning for making an investment. Again, the goal is to be a long-term investor, but you have to understand how and where the money is moving. This is, by the way, if you sign up for my masterclass, this is what I teach you. I teach you how we find these types of market shifts, because it takes more work. So active investing, more risk for more potential return. Passive investing, less time, less risk, less potential return. Again, neither one is right or wrong. You got to find what's right for you. And the way that you invest your money successfully is to, number one, pick which asset that you want to invest in, stocks or real estate to start. Number two is figure out how aggressive you want to be, active or passive, 80-20, 50-50, 20-80. And then number three, execute. On your passive investments, ABB. On your active investments, find the market shifts. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.